Usually when we talk about high-level mathematics, there's this assumption of absolute unbreakable truth. Like 2 plus 2 is 4, you drop an apple, gravity pulls it down, it's clean, it's predictable.
Right, yeah. The physical laws of the universe just don't panic. They don't, change their minds based on the morning news cycle or a bad earnings report.
Exactly. But then you step into the world of quantitative finance, specifically options trading, and suddenly you're trying to apply those perfect rational laws of physics to a market made entirely of highly irrational, emotional human beings.
It is the absolute definition of a mathematical collision.
It really is. And the results are, well, honestly, they're wildly counterintuitive. You have these pristine, elegant equations constantly slamming into raw human fear.
Right, and understanding that exact collision is where the real edge is. Because when you strip away the flashing red and green numbers on your screen, you start to see the foundation. You see how the theoretical math of pricing options connects directly to the... Oh, they definitely do. But we can break them down into plain English. Within this continuous time model, the value of a European option is essentially derived by evaluating its expected payoff at the expiration date, right? And then discounting that number back to today's value using a risk-free interest rate.
Okay, that makes sense.
Yeah, and the formula actually partitions the option into two distinct components, a stock component and a cash component. And the heavy mathematical lifting is done by two critical parameters, simply known as D1 and D2.
Right, and here is where I need some help translating. In the math, we run into the standard normal cumulative distribution function. The research represents these as ND1 and ND2.
Exactly.
Now, looking at this, ND2 seems pretty straightforward. It's described as just a purely risk-neutral probability that the option will expire in the money. Is that right?
Spot on. For a call option, ND2 is simply the probability in a theoretically perfect risk-neutral world that the final stock price will end up higher than your chosen strike price at expiration.
So just a flat probability.
Right. It is a pure, unadjusted likelihood of exercise. But ND1, well, that is where the structural genius of the model actually lies. ND1 represents the option's delta.
Delta. Okay, so it's not just a flat probability then. The sources describe delta, or ND1, as a risk-adjusted hedge ratio. What does that mean in practical terms?
It dictates the exact number of fractional shares a trader would need to buy or short to construct what's called a self-financing replicating portfolio.
A self-financing replicating portfolio.
Yeah, so if you want to perfectly hedge the option you just sold, like to completely neutralize your risk, ND1 tells you the precise multiplier. You hold a certain amount of expected stock based on that number, and you finance that position with cash.
Wait, looking at these equations, though, ND1 is always mathematically larger than ND2 for call options. Why is there a bias? I mean, if one is the probability of winning and the other is the hedge, why aren't they the exact same number?
It's because of the volatility. In the math, you have to factor in that a more volatile stock doesn't just have a higher chance of hitting your target strike price.
Right. It could blow right past it.
Exactly. If it does hit, it's likely going to blow right past it, making the shares you promised to deliver worth significantly more. So ND1 is larger because it includes a volatility term, specifically the annualized implied volatility multiplied by the square root of time.
Oh, wow.
Yeah, it reflects the expected value of those shares, conditional on the option actually expiring in the money. You need more shares to hedge a wild stock than a calm one, even if their baseline probability of crossing the finish line is the exact same.
That is fascinating. So the math inherently accounts for the severity of the move, not just the likelihood.
Precisely. And because these cumulative normal distribution functions don't have a simple, clean analytical solution you can just, jot down on a napkin, high-frequency trading platforms can't just plug them into a basic calculator.
Right. They need speed.
Right. They use highly complex, rational, and polynomial approximations. We are talking about algorithms doing these calculations on the fly, bounded by a strict error tolerance of less than 7.5 times 10 to the negative 8th power.
That is incredibly precise.
It has to be. It has to be virtually instantaneous and structurally flawless.
But I mean, all of this flawless math assumes a risk-neutral world. Moving from that theoretical risk-neutral measure to the real-world physical probability of a stock hitting a price, it feels like taking a highly complex, delicate recipe written in French and translating it into English.
That's a good way to put it.
But in the process, you are forced to replace the single most important ingredient. The equations say, to make this work in reality, you have to replace the simple risk-free rate with the expected real-world drift of the stock.
Yes, which is denoted in the research by the Greek letter mu.
Right. But the sources flat out state that estimating the expected real-world drift of a stock is notoriously impossible because of low autocorrelation in stock returns. You just can't predict it accurately.
No, you really can't.
So I have to push back here. If you literally cannot calculate the real-world drift, the one ingredient you desperately need, how do these models survive contact with reality?
Well, this raises an important question, and it's the exact problem that quantitative analysts wrestle with. It's why the perfect math collides with the messy real world.
Right.
The physical world completely shatters the neat, continuous geometric Brownian motion assumptions of black schools. The real world has stochastic volatility. It has fat tails, and it has volatility smiles.
Hold on, let's translate that for a second for everyone. Stochastic volatility basically means the volatility itself is bouncing around unpredictably, right?
Yes, exactly.
And fat tails means that those massive, once-in-a-lifetime market crashes happen a lot more often than standard bell curve math says they should.
Spot on. And volatility smiles occur because market participants know the underlying math is imperfect. So traders manually override the prices for extreme out-of-the-money options, charging more for them.
Because they're scared of those fat tails.
Right. And when you plot those inflated prices on a chart, it creates a curve that looks like a smile. Because calculating the real-world drift is effectively impossible, the market collectively decided to bypass it entirely. Instead of guessing the drift, they rely on implied volatility.
And here is where human psychology hijacks the math. Because humans are involved and humans are terrified creatures, human emotion consistently overprices this implied volatility. We overpay for fear.
We do, every time.
Which creates a massive exploitable gap for systematic traders. The sources call this gap the Volatility Risk Premium, or VRP.
What's truly fascinating is the sheer persistence of this anomaly. The VRP is defined as the gap between the 30-day implied volatility, which is what the market is aggressively pricing in right now, and the 20-day realized volatility, which is what the market actually does in reality over the following month.
The data on this is staggering. Since 1990, the VIX, which tracks the 30-day implied volatility of the S&P 500, has averaged about 19.6%. But the actual realized volatility of the S&P 500 over that exact same multi-decade period averaged only 15.5%. That is a 4.1 percentage point gap. It means that implied volatility overshoots reality on roughly 3 out of every 4 trading days.
3 out of 4 days, the market pays a massive premium for a storm that never arrives. And traders use a brilliant mental shortcut to visualize this called the Rule of 16.
The Rule of 16.
Yeah. If you take an annualized volatility percentage and divide it by 16, which happens to be roughly the square root of the 252 trading days in a calendar year, you get the expected daily percentage move of the asset.
Okay, let's run the math on that. If the market has a 30% implied volatility divided by 16, it implies the stock will swing about 1.9% every single day.
Exactly.
But if the realized volatility turns out to be only 20%, you divide that by 16, and the actual daily moves are just 1.25%.
And that seemingly small daily gap translates directly into substantial dollars. Let's say you have an at-the-money straddle on a $100 stock. At that 30% implied volatility, the option premium costs $6.90. But when the stock only realizes 20% volatility, the fair mathematical value at expiration was actually only $4.60.
So the systematic option seller just captured a $2.30 gap, which is 2.3% of the stock price in a single month, purely for providing the insurance.
Purely for providing insurance. Yep.
It's like a homeowner buying overly expensive hurricane insurance every single month just because a terrible storm hit a decade ago.
That's a perfect way to look at it.
But here's where it gets really interesting. If this 4.1% gap has existed since 1990 and practically a structural law of the market at this point, why haven't massive institutional algorithms just arbitraged it down to zero by now?
Because of a powerful behavioral finance concept known as the Peso Problem. Markets are constantly pricing in rare, catastrophic, world-ending events that don't actually occur in the observed sample.
So the fear just never goes away.
Never. You are seeing premiums stay elevated because humans have a deep psychological aversion to tail risk. We are hardwired to survive, so we overpay to protect our portfolios from total ruin.
So the demand for portfolio insurance is just massive and constant.
Exactly. And the speculators who sell that insurance face structural and capital limits. I mean, they only have so much margin to deploy, which prevents them from fully satisfying all that market demand. That friction keeps option prices structurally elevated.
That makes total sense.
And this isn't just a quirk of the American stock market either. The VRP is incredibly visible in crypto and foreign exchange. Hedge funds literally build currency VRP portfolios, buying currencies where realized volatility is higher than implied and shorting the ones where the insurance is too expensive.
Okay, so the volatility risk premium provides this constant underlying mathematical edge.
Yeah.
But if humans warp the premium constantly, traders need a fast, dynamic way to track their odds of winning on the fly while they are trading.
Right, because things change fast.
Exactly. And that takes it back to delta. Because option chains are updating continuously, the research says traders use the absolute value of delta as a real-time proxy for the probability of profit.
And it works beautifully in practice because of the absolute sum rule. If you look at a call and a put on the exact same strike price and expiration date, their absolute deltas must sum to approximately 1.00.
So if a call has a delta of 0.36, the put on that same strike has to be negative 0.64. Which perfectly matches a 36% and 64% binary probability distribution.
Exactly. It's incredibly intuitive.
You're essentially using dynamic delta like checking a continuously updating weather app on your phone. As the clouds roll in and the stock moves, the probability of rain updates second by second. But looking at the mechanics of this, I see a major flaw.
Oh, what's that?
The math relies on an input called 30-day historical volatility.
Yes, it does.
But if your dynamic, real-time probability is relying on a backward-looking 30-day metric, isn't that like driving a car on the highway while only looking in the rearview mirror? Doesn't it make the model too sluggish to react to sudden, violent market crashes, creating a moment-in-time paradox where your probabilities are just immediately wrong?
Well, if we connect this to the bigger picture, it's a highly logical concern, but empirical data completely refutes that fear.
Really?
Yeah. Researchers analyzed massive data sets of live trades using calibration metrics to test exactly this. They used Breyer scores and ROC-AUC scores.
Okay, let's pause and translate those. What exactly is an ROC-AUC score?
Think of ROC-AUC as a grading scale for prediction models. A score of 0.50 means the model is as accurate as a blind coin flip.
Okay.
A perfect 1.0 means you have a crystal ball. These 30-day historical volatility models consistently scored a roughly 0.70.
Oh, wow.
Yeah, in the chaotic, noisy world of the stock market, a 0.70 is like having loaded dice.
Okay, so the backward-looking metric actually works. But why?
The Breyer score trends, which measure the accuracy of probabilistic forecasts, showed zero significant spikes during market shocks, meaning the models do not degrade over time.
So they don't break when the market panics.
Exactly. The backward-looking historical volatility actually acts as an anchor for volatility regimes. In quiet regimes, it edges probabilities higher, keeping you confident. When a volatile regime hits, it instantly compresses those probabilities, allowing the model to adapt dynamically.
It just adapts on the fly.
Right. The law of large numbers takes over. In fact, continuously quoted market probabilities actually outperform the static metrics calculated at the entry of the trade.
All right, so delta tells you your statistical odds at the finish line, at expiration. But a trade isn't just about the finish line. What happens to the underlying asset during the race, like on a random Tuesday, 3 weeks before expiration?
That's the real test.
Right. The difference between the probability of expiring in the money and the probability of touch, or POT, is crucial. And frankly, it's dangerous.
This is where many newer traders get completely wiped out. Under standard continuous Brownian motion, there is something called the reflection principle.
The reflection principle.
Yeah. This mathematical principle dictates that the probability of a random walk touching a barrier during a given time frame is exactly twice the probability of it ending beyond that barrier at maturity.
That is wild.
Yeah,
So the probability of touch is roughly 2 times the delta.
exactly. Let's say you sell a 20 delta option. That gives you an 80% statistical chance of the option expiring out of the money, letting you keep the premium.
It sounds like a highly safe conservative trade.
It does. But a 20 delta option has a massive 40% chance of touching its strike price at some point during the life of the trade.
This completely destroys the traditional advice of using tight stop-loss orders.
Oh, completely.
I mean, if you set a standard stop-loss at your strike price, you have a 40% chance of being stopped out for a guaranteed loss on a trade that had an 80% chance of ultimately being a winner.
It's crazy, right?
It's like bailing out of a roller coaster mid-ride, like jumping out of your seat just because the track did a loop, completely ruining a mathematically sound journey.
That is a perfect analogy.
Yeah.
You are guaranteeing a loss by panicking during the entirely expected variance of the asset. Now, the data does show some structural asymmetries in the real market. Puts have a systematically lower probability of touch than theoretically expected. Calls, on the other hand, closely match that 2x mathematical theory.
Wait, why do puts act differently than calls? Shouldn't the math be symmetrical?
It comes down to market psychology. The old saying goes, markets take the stairs up and the elevator down. Equity markets have a natural upward drift over time, which constantly pulls prices away from put
Oh,
strikes.
I see.
Furthermore, when a stock drops sharply, panic spikes volatility. But those volatility spikes tend to be mean reverting. When the panic fades, the stock usually rebounds, meaning puts get tested less often than the pure math suggests.
So if stop losses ruin the math, and the underlying asset is practically guaranteed to swing wildly during the trade, how do you genuinely defend a portfolio? Is early time management the only way?
It is the single most effective defense. The research shows that managing positions early radically alters the math in your favor. If you sell an option with 45 days to expiration, or DTE, and you systematically exit that position at 21 DTE, you reduce the chance of a strike test by more than half.
Wow.
Yeah, the probability of touch ratio drops from 2.0 down to approximately 0.8 for puts.
That is a massive risk reduction just for closing a trade 3 weeks early. Okay, so closing a trade at 21 days saves you from the roller coaster. But an institutional desk is managing billions of dollars across thousands of options. They can't just manually close trades one by one to avoid risk. How do professionals synthesize all this math, delta, VRP, and probability of touch to build portfolios that don't blow up overnight?
They do it through aggressive portfolio delta risk management. Because options act as fractional shares, a portfolio manager can aggregate the directional risk of the entire portfolio into a single net delta number.
Right, so a call with a 0.30 delta is mathematically equivalent to holding 30 shares of the stock. So they just add up all the fractional shares across the whole portfolio.
Exactly.
But the danger is that options markets close at 4:00 p.m., which introduces overnight gamma risk. Let's make sure we explain gamma clearly for you.
Right. Gamma is the rate of change of delta. To use an analogy, if delta is the speedometer of your car telling you how fast your risk is moving, gamma is the accelerator pedal.
So you can park your car on Friday afternoon going 0 miles an hour, perfectly delta neutral.
Yeah.
So what does this all mean? Well, overnight, gamma acts like a brick on the gas pedal. Due to a weekend news event or geopolitical shock, by Monday morning before you can even touch the steering wheel, your portfolio is doing 100 miles an hour in the wrong direction. It's like parking your car in a safe neighborhood that turns into a war zone by morning.
Exactly. When the options market opens on Monday, the damage is already done. To prevent that crash, institutional desks hedge using highly liquid derivatives that trade nearly 24 hours a day, 5 days a week. Things like CME Group single stock futures or equity index futures.
Okay, how does the math work there?
It's beautifully simple. They take the total dollar delta exposure of the options portfolio and divide it by the notional value of the futures contract.
Let's walk through the example from the sources to lock this in. If a manager has a $1 million equity portfolio, they look at the E-mini S&P 500 futures contract. If the index is at 2,185 with a $50 multiplier, the notional value of one contract is $109,250.
Correct.
You divide the $1 million by that $109,250, and it tells the manager they need exactly 9 futures contracts to hedge the entire house.
That's it. And if the market drops by 3% overnight, the $30,000 loss on the equity portfolio is almost perfectly offset by a $29,475 gain on the short futures position.
Wow, that's incredibly effective.
Right. The manager turns a catastrophic 3% gap down into a negligible 0.3% net loss. Similarly, in the foreign exchange markets, banks use systems like CME Group's FX Link to seamlessly transition over-the-counter options hedges into centrally cleared on-exchange futures positions, eliminating basis risk entirely.
And they execute all of this at lightning speed, using systems like CME Direct ATM straddle grids or TT auto hedgers that dynamically buy and sell the underlying asset the millisecond an option order is filled.
Exactly. It's all automated.
But obviously you, the everyday listener tuning in right now, do not have a direct line to an institutional auto hedging supercomputer. How can an individual trader apply these institutional safeguards?
By using strict systematic rules that act as behavioral substitutes for that high-frequency execution. While a retail trader isn't using FX Link, they can implement the 2 golden rules of premium selling, specifically for strategies like iron condors or strangles.
And rule number 1.
Rule number 1 is the 50% profit target rule. You close the position the moment you capture half of the initial credit. You never hold it to expiration just to squeeze out a few extra pennies while risking all your accumulated paper profits.
And rule number 2 is the 21 DTE exit rule we talked about earlier.
Exactly. Exiting at 21 days to expiration completely keeps you out of the late stage high gamma zone where option prices become violently sensitive to small moves in the stock. By strictly adhering to those two rules, you insulate yourself from tail risks almost as effectively as an institutional futures hedge.
It is incredible how these layers build on each other. We started this deep dive looking at the incredibly dense theoretical equations of Black-Scholes, ND1 and ND2, and we traced how that risk-neutral math gets warped by human fear, creating the volatility risk premium.
We saw how trusting absolute delta acts as a dynamic, real-time proxy for success, assuming, of course, that you survive the probability of touch by not panicking and using stop losses during the ride.
Right. And finally, we arrived at the systematic rules, taking profits of 50% and exiting at 21 DTE, that allow anyone to implement institutional-grade portfolio management. You now are armed with the mechanical why behind options pricing. You have the framework to look past the noise and understand the deep structural advantages of variance risk sellers.
You are no longer just guessing, you understand the exact mechanics of the edge.
But I want to leave you with a final, forward-looking thought to ponder on your own. We know the volatility risk premium exists because of the peso problem. Human fear, the constant dread of an unseen crash, keeps insurance prices artificially high. But as algorithmic execution becomes flawlessly efficient, and as artificial intelligence begins to completely dominate systematic trading platforms, will that behavioral inefficiency eventually be priced out of the market entirely?
Or is human fear so deeply hardwired into our psychology that the volatility risk premium will exist as long as markets do?
Makes you wonder. Maybe the laws of quantitative finance will always be a little less like gravity and a little more like human nature. Until next time.